Good day, everyone. So today we're going to be taking a look at this PDF, getting started in Forex. So let's get started. These are the table of contents and what we're going to be talking about. So let's get to the first part. So why Forex? The Forex market is where traders from around the world can trade the currencies of global currencies or in union of countries as in Europe. The Forex market is the largest financial market in the world with an estimated $4 trillion transaction daily. That's 160 times the volume of New York Stock Exchange. To get a sense of how large the market is, consider the amount traded in 4 days could pay off entire United States debt. Not only does Forex offer benefits of being the largest market in the world, through trading currencies, it is naturally almost the most liquid market available. Forex is seamless, decentralized 24-hour market that follows global banking activities from one international market to another. Unlike in other markets, Forex traders can trade 24 hours a day from Sunday through Friday. So, Forex, that's what Forex is all about. Now, let's look at it. This map here it shows the session that we trade. We have the Asian session, we have the London session, and we have the New York session. Those are three major sessions in the Forex market. So in Nigerian time, the Asian session starts from 11 a.m. to 7 a.m. Nigerian time. Then the London session starts from 7 a.m. Nigerian time to I think 1:30. It doesn't stop at 1:30. It continues to like around 4 or 5 in the evening. But the New York session and the London session they overlap each other because once the London New York session starts around 1:30 p.m. Nigerian time, so the London session and New York session they are clashing together. So there's going to be a lot of movement in the market as we progress in this course. You understand what they call movement and what we call price action in the forex market. So we have leverage. Currency trading can be significantly and flexibly leveraged. Outside of the United States, the leverage is up to 200 ratio 1, meaning that traders can put up to $1 but control up to $200 in a margin trade. While this would magnify your profits, leverage can also magnify losses. So leverage is like if we deposit $100, let's say we deposit $100 in our forex account, and we have 200 leverage. That means we already have like 20,000. We can open a trade of 20,000. If I let me see if I'm correct, because 200 times 100 should be 20,000 times 100, 20,000. So the money is not real. The money is literally not real, but they've given us opportunity to trade higher positions because of 1 unit of GBP USD, a forex pair. 1 unit is over 100,000. That means you can even trade the 1 unit. You have to trade like the micro or the nano. That's 0.1 lot size or 0.01 lot size. That's 1,000 units, and 0.1 is um 10,000 units. We are going to understand this too, in the future as we go on progressing in the course. So now let's look to mechanics of currency trading. All these things are going to be done practically, so you will understand them. This is just a PDF just to like we are getting started with forex. So we have mechanics of forex of currency trading. We have buy versus sell. So let's see what it said. Forex trading is buying of one currency while another simultaneously selling another currency. These currencies expressed in pairs are always connected to each other, as the value of one currency cannot change unless it's compared to another. Trading in this marketplace is unique because there are equal opportunities to buy and sell these currency pairs. If you buy a currency pair expecting to increase the value, you are going long. If you sell a currency pair expecting to decrease, you are shorting. Whether you are going long or shorting in this market, one currency is always going stronger against another, and one currency is always getting weaker, creating an opportunity for any type of trader. So, buying and selling. If you are buying, you are going long. If you are selling, you are shorting. So if you someone say long this particular trading pair, you need to buy. And then they say short this particular trading pair, you need to sell. So you buy when the price is going up. In this course, we're going to understand when price is going up. Price is going to the upside, then we buy. Then when we sell when price is shorting, that means we need to know the trend. We need to know that the trend is going down, that the trend is going downward, or the trend is going upward. We are going to understand all these things when we start working on the chart and everything. Everything that I'm saying here, you are going to understand it when we start working on the practical aspects of this course. Now they say the two primary reasons people trade forex are for speculation. 70 to 80% of forex trading is for pure speculation. People who trade for speculation expect benefits from one change in value of one currency versus another currency, similar to how a trader might speculate on the change in a stock's value. Conversion: 20 to 30% of daily forex activity is for conversion or delivery. If McDonald's Corporation wants to convert Japanese yen profit from selling hamburgers in Japan in domestic dollars, they will transact another counterparty, usually a bank, to sell JPY in exchange for USD. So for this speculations like people like us, we normal forex traders. While conversion is for like companies, like if you have a company that earns in US dollar, but someone bought something from you and they paid in Japanese yen, you need your bank to help you convert it to US dollars. So that's what they're talking about conversion. Now we have currency pairs. The next one is currency pairs. The value of each individual currency is relative to other currencies. The euro, for example, only has value if compared against the value of another currency, like the US dollar. Like the US dollar. That is why currencies are traded in pairs and not as single currencies. So currency pair are just that individual currencies are paired up. Example include Euro USD, which is Euro against US dollar, USD JPY, which is USD against the Japanese yen, and JPP CHF, which is a British pound against Swiss franc, that's Switzerland franc. Then the first currency in the pair is called the base currency. The second currency in the pair is called the quote currency and the counter currency. So if we say that the current price of Euro USD is quoted at an exchange rate of 1.2 $1 1.2, this would mean that 1.2 of the quote currency USD is equal to 1 of the base currency. So for example, we say now the base is Euro USD and the quote is USD. So if the base, for example, if the base is $1, which is euro, then the quote is going to be $1. If the base, if the base is €1, then to convert it to dollars, it will be $1.20. That's what you've seen here. So let me just give you an example. If the base currency is strong, the price goes up. That's when you buy. But if the base currency is weakened, that means the quote currency, which is USD, has gained strength, so you short. You understand all these things as you keep on understanding the market and chart and everything, as you keep on learning. And they say buying a currency pair is the same as buying the base currency. Like I said earlier, you buy when the base currency is strong, when it's going up. So buying a base currency, buying a currency pair is the same as buying the base currency, while simultaneously shorting the quote currency. By the same token, selling short a currency pair is the same as selling short the base currency while simultaneously buying the quote currency. If a trader thinks that the base currency will go up in relative value while the quote currency will go down in relative value, the trader should buy the currency pair. If instead the trader thinks that the base currency will go down in relative value while the quote currency will go up in relative value, the trader should sell short the currency pair. Sorry. So you look at this Euro USD, that this arrow here around the side, they said Euro USD. If they see that the arrow is up in Euro and USD is down, so you buy, and Euro is down, USD you sell. So for example, now in Euro USD, the base is Euro, and USD is the quote. That means if the euros, this why if euros is strong, as euros is strong, US dollar has weakened, you buy. As euro is weak, USD is gaining strength, you sell. So in the market chart, you also see that if the price is going up, that means euro has gained strength, while USD is has not gained any strength. That means more people are buying euro than USD. And euro USD, if we are selling, that means more people are interested in buying USD than buying euros. So that's how it works. Now we see currency pairs. Forex trading offers limited number of trading instruments, namely currencies, to help focus trading effort on key currency pairs. In addition to major currency pairs, Forex also offers trading on the commodity pairs: Australian US dollars, USD CAD, that's CAD is Canadian dollar, and the major courses Euro GBP, Euro JPY, GBP JPY. Commodity pairs. These pairs are highly correlated to certain commodity prices. Generally speaking, odd USD and USD NSD correlates with gold prices, and USD CAD correlates with oil. So commodities are oil, gold, platinum, things like that. You get to know them as you keep on, but we're focusing on Forex, so we don't need to know about that for now. But you can still trade that, but you need to have high capital and need to be good, because those markets are highly volatile. Volatile is when that the market moves very fast in those type of markets. But you can start with Australian US, you can start with odd USD, that's Australian USD, Australian dollar against US dollar, Euro USD or GBP USD. That's what you should start with as a starter. Then we have corrects. These pairs do not contain the US dollar. So crosses are pairs that doesn't contain the US dollar. So we see most traded pairs USD. So the most traded pairs is Euro USD, USD JPY, GBP USD, USD CHF. Commodity pairs are odd USD, USD CAD, and USD NSD. Then we have major courses. Major courses are ones that does not have US dollar in it. That's Euro GBP, GBP JPY, and Euro JPY. So the most currencies traded are US dollar, euros, Japanese yen, and British pound. Nigeria one is not there. I think the only African one that is there is South African rand. South African rand against US dollar, or US dollar against South African rand. So that's one that we have. There's USD against NGN. That's like to see exchange rates in Nigeria, but they don't trade it as Forex. Only South African rands that they trade as Forex. Now we look at pips. Pips are the primary units of movement for all currencies pair exchange rate. So, for example, if USD moves up from $1, 2000 cents, something like that, to $1, 2000 points, 2001 cents. I think it's 2001 cents here. So this is a bullish movement of 1 pip. So, which in the case is an exchange rate movement of 1/110 of $1 cent. So major currency pairs can routinely move 100 pips per day. So if we have 1.2001 pips, then the price now moves up to $1, 2005 pips, 2005 cents. The price have already moved 4 pips already. So that's what we get to understand pips when we start moving on the chart. So we also have fractional pips. Providing an additional tenth of pip allows traders to minimize their cost and take advantage of even the most minute market movements. Now lots. Lots are measurements of the number of units of a currency pair that are being traded using lots. Using lots simplifies trading in forex markets, and it provides a standardized trade size. So, like I said earlier at the beginning of this video, lot size. Lot size is there's the micro, there's the nano, and there's micro, nano, and mini micro, something like that. So we have the first one is 0.01, then we have 0.1, then we have 1 lot size, we have 10 lot size, we have 100 lot size. So 1 lot size is 100,000 units of the base currency. So they say a standard lot is what 100,000 units of the nominal value of the base currency. That's what I said. Then the minimum lot size is that 0.01 is 10,000 units. Sorry, 10,000 units, and a micro lot is worth 1000 units. So the micro lot is 0.01. That's what you should start with as a beginner. That's what every beginner starts with. Then as you keep on progressing, knowing forex in and out, you start having big capitals. You cannot start moving to 0.1. The moment that you have big money, you cannot start using one lot size, because if you use one lot size or 0.1 lot size with a small capital on your forex account, you're going to blow it. That's just how the game works. So for example, on the Euro USD, each pip movement on a standard lot trade is equivalent to $10 a movement. So on the standard lot, which is one lot size, if the price is moving a pip, that's then you're making $10 per pip, or you're losing $10 per pip. So if this price that is here, 1.20014, so that 4 is that's the fractional pip, does not have anything. The period pip is that one. So if it was from 1.2001 to 1.2002, I have already made $10 if I use one lot size. If I use 0.1 lot size, I've made $1. If I've if I use 0.01 lot size, I've already made 10 cents. So that's how you make money. And it's that vice versa. If you are losing money, you are losing $10 in one lot size, you are losing $1 per pip in 0.1 lot size, and 0.01 lot size, you are losing 10 cents. That is that as a beginner, you start with 0.01. There's emotions in trading. Now, cash flow in trading. When a trader opens and closes a position, his account is credited or debited a notional amount equal to the size of the times the exchange rate. The trader doesn't necessarily see the amount that is transacted, for he sees the current profit and loss that is reflected by this cash flow. To help you better understand this idea, let's look at the following example. So, open position, when you want to open a position in Forex, when you want to buy or sell. Mike wants to buy one standard lot size, which is 100,000 units of Euro USD at the price of 1.2350. In order to buy Euro, he has to sell the US dollar amount. So you buy 100,000 units at 1.2350 Euro USD price in dollars. So now we see, so that means we are buying something worth of 123,500. And also, if the price close, so when you want to close the position, if the price of Euro USD rises to 1.2512, Mike may want to close the position by selling the same Euro amount of 100,000. Upon closing his position, his account will be credited the dollar amount of sell 100,000 units at 1.251. So he has already made 125,120. So we're just going to subtract the total amount. So for example, I use 100,000. I use one lot size. That's 100,000 units to buy GBP Euro USD at 1.2350. Then I sold it at 1.251. I've already made money already. So we're going to add the price with the units that we use, the units that we bought. So 100,000 units. If it was 0.1, that would be like, if it was 0.1, it would be 10,000 units. If it was 0.01, it's 1,000 units. But since it's one lot size, it's going to be 100,000 units. So that will be 100, and that will be in hundreds of thousands. So we'll now subtract, when you add the price to the unit, the price you bought it, you add it to the unit, and the price you sold, you add it to the unit. Then we'll subtract them from each other. The overall profit is 1,620,000 US dollars. Do the math by yourself, you are going to get it. Because I'm going to give assignments, and you guys must get what I'm trying to explain to you all. So you can take a look at it, screenshot it. I think I've sent the PDF to you too, so you can use this to go and check. Now we have at margin and leverage. Traders and brokers are only exposed to change in market value on open positions. The change in value of most currency pairs move about $1 a day. In fact, in 2011, the average value for the Euro USD per day was 1.57. $1.57. The US TJPY average was 88 cents, That's not much. As a result, the retail traders are given leverage to open positions. Leverage allows traders to control large positions with a lower amount of funds. I said this at the beginning of the video. So this can be good, but it can also be bad. Leverage simplifies your gains as well as your loss. I tell you that in leverage, the way you make money, that's the way you lose. So in that leverage of a thing, you need to be very, very careful when you're choosing leverage, because when you over leverage your account, you can blow. All these things you will understand. I know they sound new to you people, but you understand them. Now let's take a look at as an example of the effect of leverage. Maybe deposit $10,000 in a FXD account. FXD is the broker, but that's not the broker I use. I'll send you guys the link to the broker that I use so you can register. And I'm also going to make a video on how to deposit in the broker, and how to also make money, how to trade, and also how to link it to MetaTrader 5 and use TradingView for your analysis. She's encouraged by a strong US employment report to buy US dollar. Since she feels Japanese yen is too high, she buys USD JPY with the expectation that the USD will appreciate against the JPY. Remember, JPY will depreciate relatively as USD rises. I told you that time that when you buy, like now, USD JPY, the base currency is USD, then the quote currency is JPY. So if USD goes up, that means it has gained strength, it is appreciating. Then JPY is losing strength, it's depreciating. But if JPY should appreciate, then US is losing strength. That's why the price will start going down. So market Mary buys one standard lot size, a national amount of 100,000 USD of USD JPY at rate of 79.50. To control that position, Mary needs a post margin from USD $10,000 of available funds in account. With leverage of 50, Mary needed only pledge Maybe need only pledge 2,000 US dollars as margin on USD 100,000 position. However, since there is 8,000 of unpledged funds still in her account, so $10,000 minus $2,000 margin use, so that's how they get the $8,000. Mary has the room to take even larger positions. So if she does, let's assume Mary correct correct maybe it's correct, and USD prime moves higher from 79 to 50 to 80. At 80, Mary is content at her gain, and she takes her profit by selling equal one standard of USD JPY. Let's now see her profits and how the leverage helped her. So trade cash flows and profit. So Mary buys 100,000 units of dollars in JPY in Japanese yen at 79.50. That's 7,950,000 Japanese yen. Now she sold it at 80. Then she has already made profit. I think for profit of 5 pips. Of 5 pips. Now, as that's like $8 million Japanese yen. So 8 million Japanese yen minus 7,000. So 7,950,000 equals to 50,000 in profit. So that's how you're going to calculate it. But in all these things that we're doing, when you have a broker would not show you all these things. They only show you the profit they are making. So you don't need to come calculating all these things. The broker is going to show you that this is what you're making. But I'm not using this one to explain to you. Since Mary's account in USD, JPY profit. So the JPY profit needs to be converted into USD at the current USD JPY rate, which is example of 80 Japanese yen, implying that $1 equals to 80 Japanese yen. Therefore, a profit from $50,000 Japanese yen will equal, so JPY profit over USD JPY exchange rate, that's 50,000 over 80, 50,000 Japanese yen over 80, that's JPY USD equals to 625 USD. But all these things, like I said earlier, you see that I'm online. For ease, your trading platform automatically completes calculation for you. So you don't need to be doing all these things. All you need to do is just buy and sell. Know your leverage, know your margin, know your risk, know what you want to risk, know your risk appetite. The return on investment margin gives the trader an idea how much they made or lost on trade in terms of the investments or margin applied. In our example, we know that Mary pledged 2,000 of her margin to our USD JPY trade, and make profit of $725. To calculate our return on investment margin, divide the profit by the margin. So the return on investment is profit over margin. That's 625 USD over 2000 USD. That's 31% she gained. Wow, that's actually a good money. A good money, honestly. So technical analysis in trading, there's what they call technical analysis, and technical analysis is you like going on the chart, reviewing the chart. You use the chart to like decide where the price is going to go. Because the foreign market moves so quickly and aggressively, currency pairs are said to be highly trending, with the pair value often following a pattern of growth or decline. With so many trades going on every day, we're able to utilize common analytical tools to detect patterns and make predictions. Younger analysis attempts to predict future price movements by analyzing the past price pattern and mathematical indicators. Now we also have support and resistance. We have chart patterns, moving averages. Moving averages are indicators. I don't like using them. And we also have candlestick pattern. You need to know candlestick pattern for you to trade. I would also teach you guys that. Then we also have fundamental analysis. Fundamental analysis has to do with news. Like now, the war that is happening right now between Iran and Israel, or is it Iran or Israel? Yeah. So it's affecting the news. Trump too is even talking about it. So this is what is going to like decide if the market is going to come. There's also news like NFP, CPI, all those type of news. You are going to also go to know about them. Now you need to create a steady trading plan. That's what I'm going to teach you in the next video. Sorry about that. You also need to have a training plan, how much you want to lose, how much you're depositing, how much you're risking, the lot size you're going to use, That's what we are all about our training plan. So I think this is all. This is literally all. So I'll see you guys in the next video. I'm also going to give you guys an assignment. It will come after you guys have watched this video finish. So this is just about Forex. You can also read this to understand it again. But as we keep on doing the practical aspect of trading, you understand how the market works. And I'll see you on the next video.